We're super excited to have such a remarkable group of panelists and equally excited to have such a fantastic moderator. I'll briefly introduce Kathleen Hays, who will then in turn introduce our panelists. Kathleen is the host of Taking Stock on Bloomberg Radio, which is a weekday program covering the driving forces of the U.S. economy and global markets. In addition, she can be seen on Bloomberg TV's Asia Daybreak show, covering central banks. She is one of the top economics reporters and anchors in the country. She's covered the U.S. economy and the Federal Reserve for more than 20 years. And prior to joining Bloomberg, Kathleen spent years on the air and as an online economics correspondent at both CNN and CNBC, where she served as host, correspondent, and commentator for numerous programs. Please join us in welcoming Kathleen Hays.
First of all, thanks to the Jewish Communal Fund for inviting me back. Last year was my first time moderating this annual panel, and it was fun and interesting, and I was really pleased that I did a good enough job that they said, would you do it again? So it's nice to be here with you on this rainy, balmy, I was going to say October morning. Right? So let's get right to it. And oops, I've got to set this down so I don't keep making it, there we go. And I think this year, I'd just like to say that I think our focus this year is probably a bit more on the investment landscape. I think last year there were so many big questions over the economy, and we are going to touch on those, but I think we're at a point now where this is the perfect panel at the perfect time. So let me introduce them, and let me just make sure you know, when you're in TV, you have to make sure you always have people's names and titles in front of you, right? No matter how well you think you know them. And let's just go in order. Let's start with Mark Anson. He joined the Commonfund in 2016 as the CIO, Chief Investment Officer. He's responsible for everything they do, everything they invest in around the world, $30 billion of assets under management. He was at the Bass Family Office, Nuveen Investments. I'm not going to read the whole thing. It's right here, but it's too long to read. He's done too much. Next up, let's introduce Deborah Fine. Fine Capital Partners. She's the founder and president. Founded in 2004, and that in itself, of course, is quite an accomplishment to start a hedge fund and keep it going at a time when hedge funds and markets generally have seen a lot of ups and downs. And not only that, it's one of only a handful of investment firms run by Lowe's Corporation, Sanford C. Bernstein. This is another person who's learned it by doing it, learned it on the street, and here she is applying it for her customers. Itay Goldstein, get right up here, Wharton School at UPenn. He's professor of finance. He's been there for 14 years, coordinator of their PhD program in finance, professor of economics at UPenn. He started his academic career at Tel Aviv University, and I think what I love about this combination of people is you put a lot of this in the professor's view of the framework and where we are now as well. So I asked them all, for starters, to take just a couple of minutes, 5 minutes, 3 minutes, whatever, because I want to get more into the questions and leave time for your questions at the end, of course, in terms of kind of what you do and just as important or more important, what's front and center for you right now? I want to introduce you and your thoughts to this audience, and let's start with you, Mark.
So what do? I'm responsible for all the investments at the Commonfund, and we invest across every asset class, everything from commodities through venture capital, private credit, et cetera. As noted, we manage about $30 billion, primarily for endowments and foundations for the not-for-profit sector. I'd say what's remarkable about the market right now is the market continues to go up almost every day. Every day we start to hit a new high in the stock market, not only domestically but globally. And yet, no one seems happy. Everyone's kind of worried and a little scared, myself included. You know, we have extremely low volatility, half of what we normally should see in the stock market. We have a Fed that we know is going to gradually increase interest rates. We have geopolitical uncertainties globally around the world. And yet with all this consternation and global turmoil, the market continues to go up. It's the old reggae song, don't worry, be happy. and we hear this from our clients too. They all are feeling the same thing, and I suspect there are a number of us in the room here today that feel we're in the same boat. But it's like, where else should I put up my money? I can't park it in cash because it pays nothing. I don't want to put it in bonds because the Fed's going to raise interest rates. That's going to be bad for duration or long-dated bonds. Where else do you put your capital? And so people just continue to put it into the market. And it's also a market we see driven by a lot of momentum. A lot of money flowing into ETFs and other exchange-traded products, which are pretty much all cap-weighted, which means that they're very momentum-driven. So they just keep piling into the winners time and time again. I'd say the last thing that worries us is, again, it remains a very narrow stock market dominated by the FANGs, Facebook, Apple, Amazon, Netflix, and Google. These are the Fab Five that have been anointed both by reality and legend at this point. Those are the 5 stocks everyone believes have captured the future and are going to survive in the future, which is a big bet to be making, given that it's, again, such a cap-weighted small group of stocks. And again, when you think about capturing the future in a world of great disruption, that's a pretty big bet to make. So amongst all those concerns, we still see the stock market going up almost day in, day out, and that begins to worry us a bit. I'll stop there.
Okay, Deborah Fine.
Hi, I'm Deborah Fine. I run a long-short equity hedge fund. We're about 40% exposed to the market. We run a very concentrated portfolio, so the vast majority of our long exposure is in 8 or 9 names. And we also see that the markets are fully valued, but we're a little bit more comfortable because we're hedged to the market. So should the market contract, we hope we'll benefit from the short side of our book. We still see value in some very controversial areas. So we're spending a bunch of time right now in investments related to Puerto Rico and in investments related to U.S. onshore oil drilling.
Itay.
Okay, so I'm Itay Goldstein. I'm a professor of finance at the Wharton School, University of Pennsylvania. And I've been doing my research typically on topics of financial fragility, financial crisis, which obviously makes the recent decade and even today an interesting time to look at. So when I did my PhD in 2001, it was after the Asian crisis. Back then, people thought the US is kind of insulated from all this. But then in 2008, we saw many of these things coming into the US and more globally, other places in the world. I think what's fascinating about what we see right now in the markets, as Mark said, is that everything is super high. You see asset prices are high in the equity market, in the bond market. Real estate prices are back to where they were before the crisis. You see money is looking for investment opportunities, and those are very hard to find. You even see bubbles starting to inflate in things like cryptocurrencies and things like that. So there is really a lot of money that is looking to be invested. Everything is high. People don't know what to do. And it certainly raises a lot of questions about potential fragilities and where all this can go. In the background, you have the Federal Reserve System and other central banks in the world who are partly responsible, contributed to the situation with loose monetary policy, low rates, quantitative easing. And as they are trying to start unwinding all this and reversing course of monetary policy, I think all these questions become sharper. Whether these high prices are going to continue or are we going to see some shakeup in the market?
Itay, first to you, in terms of, I guess, specifically this sort of Fed chair question, but more broadly, how important is the Fed right now, and what's the biggest risk in what they're doing?
Right. So I think that's a very central question, and I think we don't know for sure how important the Fed is. I mean, I think it's clear that the low rates that we have contributed a lot to current high prices. But there are two things that contribute to low rates. One of them is monetary policy, which is the responsibility of the Fed. And the other one is just natural macroeconomic developments. And one could point out two things that are going on. First of all, there is an increased demand for saving. People have more money to save and are looking for saving opportunities, which pushes rates down. And the other one is that firms have less investment opportunities and generally have more cash, and this also contributes to pushing rates down. So the low rates that certainly contribute to high prices are a combination of the Fed policy and these macroeconomic variables. And I think the big question that everyone is asking is, as the Fed is now starting to increase rates and unwind the balance sheet and start selling some of the assets, whether this will have a big effect or not. My gut feeling is that they do have to play it cautiously, because even if fundamentally they are not the main driver, people certainly pay a lot of attention to what they do. And if they sort of announce that they're going to do something abruptly, the market might react in a panic. And we saw kind of a case study of that back in 2013, where Ben Bernanke said we're going to start tapering the asset purchases, and there was this taper tantrum where all of a sudden people went out and started selling bonds as a reaction. So certainly a lot of caution is required, and this is why people pay a lot of attention as to who is going to be the next Fed chairman.
Okay. Let's go to Mark next on this, because again, global investments across practically all asset classes. And of course, we all remember when the market was really starting to pick up, and before the Fed they were just more towards the beginning of interest rate hikes, and before they started reducing their $4.5 trillion balance sheet, which I know I'm not sure how closely everybody follows this, to help get us out of the Great Recession. Lower interest rates weren't enough, because when you get to zero, you can't cut any further. So they started buying bonds, treasury bonds and mortgage-backed securities, so they could help keep bond yields low, lower the cost of investment, et cetera, et cetera. And then, of course, the ECB, well, actually, the Bank of Japan kind of started it all. ECB hopped on. So, but it was interesting because so many people, people kind of pound the table. This rally, the skeptics, especially, some of the crusty old ones, it's all because of the central banks. They're doing this. It's liquidity. Boy, when they start pulling it back, that's the end of the market and the bull run. How do you factor this into what you're doing now on the strategy you've had and the strategy you're going to have moving forward?
So starting with the Fed, and then we'll go globally. There is a lot of speculation as to who will be the new chair and whether it'll be John Taylor or Kevin Warsh or others. We're less worried about that. I think the key issue is, regardless of who is the new Fed chair, it's clarity about what his or her policy will be. The markets can react as long as they know what the game plan is. So whether you have a pitcher who's throwing curveballs or a pitcher who's throwing fastballs, just tell us whether it's going to be curveballs or fastballs, to use the baseball analogy now that we're in the World Series. And the markets can adapt to that. So that's really the first most important thing. What will be the game plan? Second, we're less worried about the Fed raising interest rates. And the reason for that is there's still a tremendous amount of quantitative easing going on globally, as we were talking. So if you look at the yield curves for Germany or Japan, they are still negative in absolute terms going out 7 years now, which, by the way, is crazy. You're buying a bond from the Japanese government or the German government, and you're paying them the right to take your money from you. That's, crazy. Who would do that? But that demonstrates that there's still quite a bit of capital out there awash in the market. And the reason why that's important, when you look at the spread between the 10-year U.S. Treasury bond and the 10-year German bond, that spread has rarely been more than 2%. And right now it's right around 2%. And the Fed watches that pretty carefully and keenly. So it's going to be very hard for our Fed to raise interest rates here in the U.S. when interest rates are still so low in Germany, France, Japan, because capital is very fluid nowadays. And if interest rates go up in the U.S., that capital will flow someplace else to find where they can borrow cheaply. So again, I think the Fed, regardless of who is the new chairman, wants transparency what his or her policy will be. And even then, given that rates are still so low globally, I think they're going to be a little bit handcuffed to raise rates too quickly.
All right, I would just say the variable that concerns us the most in the economy is labor rates and potential wage inflation. And we look at things on a very micro basis in terms of how they're going to affect the profitability of our companies. But when you have severely limited immigration, you actually have a, believe it or not, a large-scale opioid crisis, which is affecting low-end labor sources. We see this a lot in oil field companies when they're trying to start drilling again and they can't get employees to pass a drug test, which is a national tragedy. There's an awful lot of demand, and now you have a lot of demand for construction, obviously post the hurricanes in Florida and Texas. That it might not be completely a discretionary choice what the Fed chair has to do if there's significant labor inflation, despite the economy not being extraordinarily robust.
To follow up on that, Deborah, for an investor like you, for a fund like you that has a very micro orientation, you choose companies that looking at what they're doing you select them off if you think they're going to make money for shareholders over a long period of time. So does that? I'm just curious then how much something like Fed tapering off its balance sheet, potentially moving liquidity rates, how much does that affect you or not affect you? Because I think that's a really interesting question for people who invest or manage other people's money. Obviously, if you're a bond fund, it's a big deal. But for a fund like you, where does it intersect or not intersect for you with these more global macro forces?
Well, interest rates are a big deal for anybody. I mean, inflation is a big deal regardless of what asset class you're investing in. But we take the view that we have no ability to forecast where interest rates are going to be. I mean, people have been calling the top of this market interest rates bottoming, I think, for 3 or 4 years now. So we try to evaluate the risks that we can evaluate. And for the risks that we don't have an opinion on, like interest rates or the price of gold or exchange rates or GDP growth, we try to do different scenario analyses for our companies to figure out how they would be impacted by those variables and assess that into the risks that we have to owning the stock. So to oversimplify it, if we thought that a company's fortunes were completely dependent on what interest rates were going to be in 2 or 3 years from now, we wouldn't own it because we don't feel that we have any value, and we think that lots of people don't have a lot of value in being able to forecast macroeconomic variables, because the whole kind of notion of risk is that you don't know what the risk is going to be. If you knew what the risk was, then you probably could assess it. So we don't spend a lot of time talking about where the market's going, what interest rates are going to be. We're not very good at it, and every time we make a prediction, it's wrong. So we don't do it.
Well, I guess one risk that nobody can completely avoid is the risks from Washington right now. And in a real basic way, it's whether you like it or hate it, whatever you make of it, it's a time of change. It's a time of, we've got disruptors all over the world in all kinds of places, and seems to be disruption coming out of Washington right now. So I'd like to kind of look at this question of the Trump administration, Congress, where it's heading. And Mark, I know that you think, well, what do you think? What matters to you?
Throw that question right back at you. Where is it heading? It's hard to guess what the Trump administration will do next or unfortunately tweet next. I think there's a couple things. One that hits home dramatically for our client base, which again are endowments and foundations. And we were talking about this before the panel began, and again, I'm not trying to sound too political, but there is going to be a bit of a vacuum in terms of support for various foundations coming from Washington. At least that's our view, which means all of us collectively in this room, as well as foundations we may serve on, are all going to have to step up to the plate a bit more, I think, for the next few years. It's going to become incumbent upon us as individual citizens and the organizations with whom we work to ensure that there can be cash flows for the various causes out there that are needy and worthy. I think we're going to see less of that from Washington. With regard to economic policy, the one positive thing I see coming out of the Trump administration is potentially tax cuts. That can have a stimulative effect. Now, one of the things they're looking at is, of course, what are called these tax inversions, where a public company in the United States merges with a foreign company overseas and then takes the domicile of that foreign company overseas to avoid the higher corporate tax rates here in the United States. So some of this tax amnesty for corporations, I think, would be beneficial, and at least try and remove that tax inversion arbitrage. Tax cuts for individuals, that's always a coin flip as to whether those tax cuts or rebates to individuals will translate into higher consumption. Now, we are an economy of consumers. We all love to shop, or at least most of us in the room do. And so there's some speculation, there's the general support that if you have higher tax cuts for individuals, somehow that'll translate into more economic growth through more consumption. But again, we think that's more of a coin flip. If anything, we see the tax breaks for corporations to be more beneficial. The U.S. does have the second highest corporate tax rate in the world, second only to Japan. And all we have to do is look at their economy, and there are 2 lost decades going on 3 lost decades to see that there are ways we can improve from that.
Deborah?
It's hard to talk about Trump. I would say that what I see are that his alleged policy decisions seem to get factored into the market, like the tax cuts that may or may not happen. I see it a lot with the steel industry, where from day one he was talking about limiting the imports of foreign steel, going against people who were dumping steel, and this got factored into the value of the equities, but of course nothing ever happens, and it's not going to happen, and then the equities don't seem to come back to where they were before the alleged policy decisions were being made. So, I mean, this is where you kind of see the froth in various sectors of the market. Things come out, people want to believe them, and then people, I guess, still believe that things are going to happen, or there's going to be some follow-through from Washington, but I think we all kind of are onto the joke that probably not much is going to happen. And that I think, poses significant risk to various sectors in the market and to the market levels overall. I mean, when the final tax plan comes out, or when it actually doesn't get passed, I think there is an enormous amount of risk for the desire to believe that all good things are going to happen to equities.
What sectors are most at risk?
You guys would probably have a better, I mean, things related to interest rates, things related to, I mean, almost every sector. Every company that pays 45% tax rates that people expect are going to go to 25%. Those companies are doing well. I can't imagine a sector that actually isn't impacted.
Where even before Trump was elected, there were a lot of people, and not just Republicans, saying that DoddFrank bill has way more than anybody needs to make the banking system safer. And some people would have argued you needed 5 important rules to make sure banks aren't too big, and that if they fail, they've got enough capital. I'm not going to do 5, but that's another big one, enough capital that they can get through it and not have to be bailed out and not help cause a great recession. So what do you see on that front, which is one of the things that, again, it seems to me that that's an area where there is a lot of focus and will continue to be.
Right. Yeah, absolutely. I mean, I think the area of financial regulation is under a lot of uncertainty right now following the new administration. It doesn't make the news as much as taxes or immigration policy, but there are only so many things that the news can focus on every day. But I think that financial regulation is something that will have to be addressed and adjusted over the years. So as a little bit of background, after the crisis of 2008, basically the US came up with the DoddFrank Act, which puts a lot of restrictions, a lot of regulations on players in the financial system. And I share the sentiment that maybe too much has been done. It is certainly a very thick piece of regulation and legislation that includes many things. But I think we have to certainly remember that some of them are well justified, and some of them serve a very important purpose. So you mentioned banks and capital requirements, liquidity requirements. I think that increasing capital requirements on banks was a good thing. I think that introducing this additional requirement, the liquidity requirement, that they have to hold enough liquidity on their balance sheet, was also a good thing. And to a large extent, this was sort of a way to implement the lessons that we learned from the crisis. Another big innovation that was introduced in Dodd-Frank was the stress tests, that the biggest banks in the US will now have to go through annual stress tests, kind of thinking about how resilient they are to future events and whether they can sustain them. So I think all these things are certainly important, and we don't want to just get rid of them as a populist measure to say that we have less financial regulation. Having said that, yes, I don't think DoddFrank was perfect. I think there are still many things that don't work as well. I think, if we were worried a lot about this too big to fail problem, I'm not sure we solved it. We still have a large concentration in the banking system. We still have very big banks. In some sense, what we see is that small banks had a tougher time to adjust to new regulation, and as a result, we now have fewer banks. So this is not such a positive development. We had one very important piece of the new financial regulation, the Volcker rule, which basically put restrictions on banks trading in financial markets. And this has made financial markets less liquid. If we're thinking about bond markets in particular, banks cannot make markets in bond markets. As a result, liquidity has gone down, and many people pointed this out as a potential area of fragility. So there are many things to sort of try to resolve and improve going forward. But I do think we have to remember that Dodd-Frank was not all bad. There were some very important measures that were introduced in it. It's not, going back to the point that the US is not the only player in the global arena. Other countries have done that too. So Europe has introduced many of these measures too, and it will be very hard for the US to completely undo it without collaboration with other countries.
Debra, liquidity is some of those things people throw out, and certainly the Volcker rule has made a difference in the bond market. Less liquidity is important in equities too. And Debra, when it comes to that question, how is liquidity in the stock market? How much has liquidity contributed to the rally we've seen, and where is it going now?
Well, I would say lately, just anecdotally, but before I get to the questions, that trading volumes have been really, really weak the last couple of weeks, which is kind of freaky when you're watching your Bloomberg and the stocks are not moving that much. You sometimes feel like you want to tap the screen and understand what's going on. So very recently, the rally has been on very, very thin volume. But I think that what's impacted the liquidity, or not hasn't impacted liquidity, it's changed liquidity, is the huge move into passive investing in ETFs. And I'm sure you're all aware, but when a stock goes up, and Mark was beginning to refer to it at the start, when a stock goes up, the ETF has to rebalance at the end of the day, which means they have to buy more of that stock, which pushes it up, which means you have to keep buying more. It's like, and the same thing when a stock is going down. When a stock is going down, the ETF needs to sell that stock because it's cap weighted, so they need a smaller amount of it, and then it goes down even more. And if it's a slightly illiquid stock, a mid-cap stock or small-cap stock or a large-cap stock that has not that big a float, it can have extraordinarily dramatic effects on the volatility of the stock. So since since our stock and trade is controversial stocks, we will now see volatility of could be 25% in a day, which is highly unusual and only happened during the credit crisis, usually around financial stocks in 2008 until 2009. So it's good if you're thoughtful about your investments and can use the volatility to your advantage, but it just means that the fortunes of a company, the stock price is not always related to actually what's going on in the company, which makes it sometimes great to manage money and sometimes extraordinarily complicated to explain to your investors why stock movements are so dramatic and actually have nothing to do with the fundamental operations of the business.
Mark, I think one of your fatigues is private capital fatigue. Does this sort of come into this question of liquidity and what's going on in some of the dynamics around markets right now?
So at the Commonfund, we've labeled a number of fatigues that our clients are feeling right now. The active-passive debate is one of the fatigues. The hedge fund fatigue is another one. The all-country world-ends ACWI versus U.S. stock market is another fatigue. And private equity is the fourth fatigue. First, just to follow up on ETFs for a moment, this is something that we are concerned about at the Commonfund. The ETF market has exploded in growth over the last 18 years. It's grown at a cumulative average growth rate, a CAGR, of 22% per year for the last 18 years. That is the fastest growing part of the asset management industry. In fact, it's the only part of the asset management industry that grew during 2008. Now, why does that concern us? Well, when you go back, way back to when the original ETF was invented, and that was the SPDR, the S&P depository receipts going back more than 20 years ago, it was a way for the average investor to get liquidity. You could buy a whole basket of stocks with just one trade. You could buy the whole S&P with just one trade. Back then, ETFs were a way of providing liquidity to small investors, but now this market is so large, it's over $3 trillion, that it's no longer a liquidity provider, it's a liquidity absorber. And it was just indicated, primarily it's a one-way trade, not only going up, but most of these ETFs are tied to capitalization-weighted indices, which are all driven by momentum. The more expensive something becomes, the more you buy it. The more you buy it, the more expensive it becomes. The more expensive it becomes, the more you buy it. And it's a spiral just going up, and it's been a one-way trade spiraling up. At some point, that market will flip around, and the ETF trade will flip around. And we don't know who's on the other side of that trade, who's going to be buying out all the people who've been buying into ETFs over the last 18 years. And what was disproportionately bought going up is going to be disproportionately sold going down. And so this does concern us quite a bit. You know, there's a fallacy out there that ETFs help make the market more efficient. I disagree. Market efficiency is all about price discovery. ETFs are not going out to discover prices. They're buying blindly what goes up. That's not market efficiency. The other thing, that just again, I'm getting on my soapbox for a moment.
That's good.
I'm just going to pick one more example. If you take the stock like Apple, Apple is in a number of ETFs across the board, but it's variously described as a growth stock, so it's in a growth ETF, as a value stock because it's long-term value, as a tech stock. Let's see what else. As a large cap stock, obviously. Oh, the best one I like, one ETF describes it as a high-paying dividend stock. Now, as you all know, dividend payout, basically zero. But the reason why it's considered to be a high dividend paying stock is because if you read the fine print of this offering circular for this ETF, it's accumulating dividends. You're like,
because it's not paying them
what
out.
does that mean? What it means is it's not paying out anything as dividends, but it just keeps generating cash flow. And at some point in the future, maybe those will translate into actual dividends. Therefore, it's a high dividend paying stock today. Now, that's silly. I call this semantic indexing. And we're seeing a lot more of this in the ETF market. And so it does concern us about what that means in terms of liquidity in the public stock market. All that aside, one of the things we do see, we still see a lot of money continuing to flow into private capital. Private capital, primarily private equity, we see the flows just increasing every year. And the reason for that is people are like, well, gosh, I can't put my money into cash because interest rates are so low. I don't want to put it into bonds. I am worried about the stock market and its valuations. Gosh, about the only thing left to play is private equity. I'll lock up my capital for the next 10 to 12 years and hope to capture some liquidity premium that goes with it. I'll stop there.
Itay, in terms of the work you do and your colleagues are doing at Wharton, when you look at this question of ETFs and how they're proliferating and how they are infecting markets and investments, what do you see?
I mean, I completely agree with what has been said. I think that initially index funds served a very important purpose because people wanted to get an easy way to get exposure to certain factors in the market. But basically, the continued growth of it is a little alarming, and I think there must be an upper bound to it, because at the end of the day, if the market is all passive, if all the investors are passive and there is no active picking of stocks and sort of fundamental information analysis, then market prices are going to become completely meaningless and people will stop investing in the public markets. Now, I think we have done a study a few years ago that I think revealed one particularly interesting aspect of it. And this is that these non-fundamental price movements as a result of mutual fund outflows actually tend to have a real effect, in the sense that you can basically look at firms whose stock prices declined as a result of mutual fund outflows. And you can see that these firms are then behaving differently. For example, they can become a takeover target. They may change their investment. So it doesn't just stop in the market. There is a potentially real effect, a spillover to the real economy, which is certainly something that we have to watch. Now, another thing I think that is kind of related to it is, as was mentioned, also the tension between public equity and private equity. And one thing that we see is that you have fewer IPOs, you have fewer firms that are publicly listed. I think firms kind of maybe to some extent lose faith or don't want to expose themselves to the fluctuations in the public equity market. As a result, they choose to stay away. Of course, also the increase in regulation and requirements on public firms certainly contributes to it, but that is also something that we need to watch.
I just want to add one other thing on ETFs. I mean, the purpose, ETFs for individual investors are fabulous structures. You accumulate, you have very low tax bills, relatively speaking, to direct investing in equities. And also the investment management industry, as you all know, the results are extremely weak. I mean, the managed assets and fees basically take away, especially after taxes, take away an enormous amount of return. So I mean, the industry, or the fallacy of the investment management industry, kind of brought it on themselves by not delivering the returns that they said they were going to generate, which led to the rise of ETFs. And people, large institutions, very large endowments, very large foundations invest in ETFs because they get better returns at a lower fee than giving it to money managers. So, I mean, it's not for nothing that ETFs are out there.
Mm-hmm. Hedge fund fatigue. Is the world fatigued? I don't think Deborah's fatigued.
I'm fatigued.
There's a lot of fatigue out there with regard to hedge funds. Back to Deborah's point, hedge funds were supposed to be the saviors to produce all this alpha for us. And unfortunately, hedge fund returns collectively have been short of that. We still invest in hedge funds. We still believe they add value to the portfolio. But now you have to really dig in and work hard to find those good managers out there that can add value. As we've been talking about, just as you look at the rise of ETFs, there are many stocks out there that are rising beyond valuations. They're being priced to perfection and beyond. So the ability to have an active manager to sort through that and find those nuggets that haven't been priced to perfection, or potentially go short those that are way too overpriced, is a competitive edge. Now, the kicker, though, is there's now something around, at best estimates, over $3 trillion in hedge funds. So the market has grown dramatically. And when you trace back the history, if you go back to the popping of the tech bubble, so the years 2000, 2001, 2002, over those 3 years, if you recall, those in the room here, the stock market declined by double digits those 3 years in a row. Not only in the US, but globally, stock markets declined 3 years in a row, double digits. During that time period, hedge funds actually lived up to their name. They eked out a positive return over that time period. So not surprising, coming out of the popping of the tech bubble, there's this huge flow of money into hedge funds because they did hedge the market. But what we've observed with hedge funds is what we call creepy beta, or beta creep. When you went from an industry that was only about $250 billion back then, which is still a lot of money, now to $3 trillion plus, all that money had to go to work, and not all of it went into alpha-generating trades. There's quite a bit of money in hedge fund land that is getting parked or allocated to good old-fashioned market risk, market beta. And so when you invest in hedge funds today, you really have to be very careful to be able to tease out how much of that hedge fund return stream is just good old-fashioned market risk that you can get through an ETF, and how much of it is true alpha or the skill of the manager. And so it takes a lot more time and effort and detective work to detect how valuable that manager is to your portfolio in terms of the amount of alpha, excess return, or skill they're bringing in, versus the amount of beta. And there's a heck of a lot more market risk or beta-like return attached to hedge funds today than there was a decade ago. And that's where the fatigue begins to build up.
So Deborah, you're in the middle of that hedge fund jungle. What can you add to this?
I think that hedge fund fees, though I reap the benefits of them, are very high. And I think particularly for individual investors who can't do the detective work, I think it's not a smart investment. I think part of a sophisticated portfolio that is looking at the alpha and the beta and the combination of all of the different instruments they're invested in. I think it has a very important place. But I think that I think it's very hard for individuals to do the work of their own. And everybody who says they're invested in the best hedge funds, ask them 5 years later if they still think they're invested in the best hedge funds. So I also think that I'm lucky to have very smart investors. And when you don't do well, they take the money away, which they should do. And when you're doing well, they also rebalance against you, because that's also what they should be doing. I should say it differently. If you're not doing well for reasons that are not a fault of your own or something to do with the market, they tend to add capital. And when you're doing quite well, they tend to pull capital away. So as long as you're quite disciplined about your rebalancing strategy, which is also quite difficult with hedge funds if the money is locked up and you can't get the money out. It's hard to be disciplined about it. It's okay, but I think for the vast majority of investors, they're not appropriate investments.
From the world of finance, what can you add?
So, there are many people in academia doing studies on mutual fund managers' skills and hedge fund managers' skills, and trying to detect who are those who know what they're doing and who are those who don't. And at the end of the day, it's really very difficult. You have a study that sort of identifies skill, and then there is a counter study that comes back and kind of negates it and says, no, what you identified as skill is not real skill, and so on. So I share the sentiment that I think at the end of the day, it's really very hard to know. This distinction between generating alpha and just generating beta, or different sorts of beta, is really hard to tell. So it's really indeed a very difficult investment to make. One thing that is sort of better about hedge funds than the old good mutual funds is the fact that investors cannot take, in many cases, investors cannot take their money out as easily as in mutual funds. I think that one source of concern that we have for mutual funds is the daily liquidity that they offer to their investors. So investors can basically take their money out of a mutual fund at any given day. Hedge funds at least put some restrictions on that. And so from the point of view of market stability, I think that's a plus.
Well, and specifically, when we were talking before the panel, you mentioned you're concerned about mutual funds that are investing so much in liquid corporate bonds. They obviously they don't trade at all like treasuries or something like that, and how they now make up something like 20% of the market. What's going on? Why is that a concern?
Right. Yeah, no, I think that's a very important trend that we see in recent years. If you think about the corporate bond market, it's a very illiquid market. It's still over-the-counter trading. Most of the trading is done over the phone. You don't have a centralized system. And as a result, corporate bonds tend to be very illiquid. Traditionally, corporate bonds have been held mostly by pension funds, by insurance companies, not so much by mutual funds. But in recent years, if you look after the crisis, 2008, 2009, and after that, there is a spike in the percentage of the corporate bond market that is held by mutual funds. Nowadays, mutual funds are about 20% of the corporate bond market. They used to be, 3-4%. I think the reason that this is potentially tricky is essentially these mutual funds are selling the illusion of liquidity, because they go to their investors, they say, look, you're investing in something that is very liquid. You can take your money out at any given day. But then what they do is they take this money and they invest it in very illiquid securities, in corporate bonds. And at the end of the day, what could happen is that many investors come to the fund at a given day wanting to take their money out. The fund will have to then liquidate many of these illiquid securities at one point in time. And this, I think, can put a lot of stress on the market. So I think this is one thing that certainly regulators are worried about, and something we should keep an eye on going forward.
Well, generally speaking, I think another thing hanging over investors in the markets is, there's been a reach for yield, because in a world where the short-term rates are so low, and people go, wow, look at the 10-year treasury got up to 2.4. Let's buy some again, right? And you mentioned Bunds, the 10-year Bund. I can't remember where it is. Has
42 basis points.
right, okay. I mean, go to Japan at 0, and you have to go to emerging markets, which are clearly riskier to get higher yields. And for the stock market, the same thing. You know, I was at the IMF World Bank meetings, I guess that was week before last, and you go to all these panels, and there's central bankers, and then there's regulators, and there's some people who are from banks and various things, and there's this like, central bankers seem to be saying, yeah, maybe valuations are stretched, certainly in developed, you know, the G7, central banks, but basically things seem okay, and it seemed much more like regulators and even bankers who were saying, maybe investors are too complacent right now, and I think it gets to this question of is the stock market too high? Has it had such a run? You know, have people reaching for yield, reaching for return in this world? Is that a risk? And let's start with you, or is it like, oh, forget about it? You know, you have very gradual rate hikes, lots of liquidity left from the central banks, earnings, economies are growing, even many European economies all over the world. What is it? And someone trying to make the best decision, right, in various investments and asset classes. What's your view, Mark?
It's actually fascinating. If you look at the main benchmark for the fixed income industry is something called now the Bloomberg BlackRock Aggregate Bond Index. Used to be the Lehman, used to be the Barclays, then it was the BlackRock, now it's the Bloomberg BlackRock Aggregate Bond Index. Regardless of its name, it's still the bond index most people look to. If you go back to 2009, as we were coming out of the Great Recession, the average yield on that index was close to 6%, and the duration, the measure of the bond risk or bond beta, was about 3. That's completely flipped around now. The duration's 6.1 right now, and the yield's about 3%. So over the last 9 years, that index has completely flipped around. You have now twice the risk of that bond index for 1/2 the yield. So bonds have not been a good bet, and that's because people continue to reach for yield, pushing bond prices down and settling for lower and lower yields. Again, that is the sign of a late cycle bull market, and this does trouble us. I was talking to a client the other day, and she had a great comment. She was, you know what? I just wish we'd have our recession, get through it, and get over with it. So we can just get back to proper valuations again. You know, and I think that sentiment's beginning to build up. People are like, oh, Christ, can't we just have a recession and be done with it? And then we can get back to investing again? So this is a concern. The reaching for yield, again, it's a clear warning sign. It is a classic warning sign of a late cycle. And we're beginning to think a bit more defensively about the portfolios we build for our clients.
Deborah?
You know, the imminent market drop is, to me, impossible to forecast. You know, there's a whole nother way of valuations correcting, which is the market doesn't do very much, and economic growth catches up with the level of the market. So fortunes have been made and lost, timing when the market is going to fall, or when then taking your money out and then knowing exactly when to put it back in. Is kind of the definition of market timing that study after study after study shows is basically impossible. So we adhere when our clients ask about this, and on all of the investment committees that I have the privilege of serving on, we have our asset allocation targets, and we rebalance in a very disciplined way. So you know, as long as there is some cash or short-term bonds and some liquidity in the portfolio so that you can use it to take advantage if there is a market drop, or you can use it to sell off asset classes that have gone outside of your asset allocation bands. We think that's the best way to manage this risk.
Any academic framework you can give us to help figure this out?
It's certainly very difficult to time the market. I think that, you know, many people took their money out of the market in 2008 because they thought it's going to continue going down, and they lost a lot of money as a result of that. People took their money out recently because they thought the market is going to start going down, and they lost a lot of money as a result of that. So that's certainly true. It's very difficult to time the market. I think what we can say more generally is that, you know, market prices are high. And I think they're high across the board, which is kind of what I started with. I mean, they're high in the equity market, they're high in the bond market, real estate markets are certainly strong these days. So they're really high across the board. And I think, all common measures, if you think about sort of, different measures of price to earning ratio, kind of suggest that the market is high. Maybe it's not at the peak, but it's fairly high. Bond prices, as a result of the low interest rates and so on, are again very, very high. So at the end of the day, my overall feeling is, yes, prices are high. I think there will be some shock eventually that will cause a drop in prices. And I think the reason that it's so difficult to time the market is it's very hard to know exactly what that shock is. What's going to be the last straw that is going to make it all fall. I mean, if you think about, say, 2008, it was the mortgage-backed securities that was kind of the thing that led to the overall collapse. I think we can point to areas of fragility. So one thing I would say is the fact that there is a lot of debt in the economy. Debt levels are still very high, even relative to what it was before the crisis. The other thing that I would point to as an area of fragility is illiquidity that I mentioned before, that bond markets are illiquid and as a result are basically prone to fluctuations. It can be the monetary policy that we mentioned, even though I certainly agree that central bankers have to act within bounds. But certain announcements or not doing things exactly the right way could sort of trigger a chain reaction that could potentially lead to a collapse. So I think the fundamentals are there that we could see a collapse. It's very hard to tell exactly when it's going to happen.
Well, I have many of my own questions that I can ask, but you are a lovely large audience, and I'm guessing that you have all kinds of things that I haven't thought of or certainly haven't asked yet. So let's open it up to your questions for a while. Don't be shy.
Ari Goodman, this is a question for Debra and anybody else. You mentioned you were going to be investing in Puerto Rico. Any particular asset classes in Puerto Rico?
We have investments in the mortgage bond insurers. Those are companies like MBIA and Assured Guaranty, because we think that even in extremely dire scenarios with losses that bonds that may be impaired all across the spectrum of Puerto Rico debt, their asset value and cash flow is more than enough to meet their obligations. We also have investments in Hemisphere Media, which is the Puerto Rican TV station and cable operator. I'm actually headed there this afternoon. And we have an investment in, which has been hurt a lot because of because of the hurricane. And we also have an investment in Lilac, which is a tracking stock of Liberty, where John Malone is trying to kind of recreate what he's done in Europe by smushing cable operators together in Latin America, and Puerto Rico is a tiny piece of that. It's like 5% of the income, but the stock's been kind of trampled because of the perception that that's much larger. I mean, our basic view on Puerto Rico is that it's beyond a tragedy what's going on there, particularly with how our White House is speaking about it. But the reality is that after natural disasters, enormous amounts of money flow, which creates jobs and creates demand. And you see this would be extremely unusual if tens, 20s, hundreds of billions of dollars don't flow into Puerto Rico to help get the economy back on its feet.
And as a side on that, Deborah, when I was at the IMF World Bank meetings, interviewing central bankers and finance ministers, who walked by? It was very funny. We were in between interviews. My field producer says, "Richard Branson just walked by." So like a dutiful, I would go down and, hi, Mr. Branson, I'm Kathleen Hays from Bloomberg TV. Will you sit down with us? And we took a little finagling, or not finagling, back and forth, because he had a meeting he had to go to, and his meeting was actually with Christine Lagarde, head of the IMF, because he's heading an initiative. He got all the Caribbean heads of state together to do a rebuilding jointly. They're meeting with the IMF and World Bank to get money, and of course he wants sustainable and solar panels. But anyway, so yeah, I think it's obviously going to be a big deal. I saw another hand raised back there.
Yeah, thanks. Paul Glazer speaking. For Mark, you said that you're going more defensive lately. Where do you go when you go defensive? Where exactly is that place?
Hopefully it's a safe place, right? A safe house. First thing we're doing, back to something Deborah said, we're working with all of our clients in what we call a crisis playbook. What happens if the market turns over like a 2008, or hopefully we don't experience that again, but if something like that happens similarly, what would be the playbook, not only for the portfolio we manage, but for the operations of either the foundation or the endowment? You know, for a foundation, what would it mean to their planned giving schedule? You know, would they be able to maintain it, or would they have to reduce it? For an endowment supporting a university, how would they react to likely budget cuts, and where would they make those budget cuts? And then what would we do in our portfolio to build up the pools of liquidity and reserves for them, not only to take advantage of the crisis when things are cheap, but also just to have what we call the shock absorbers in the portfolio, things to buffer you through difficult times. When I talk about a crisis playbook, I'm not thinking of a 10% classic market correction, or even 20%. We're talking 25 to 30% down market, and for a prolonged period of time. You know, one of the fascinating things about the Great Recession of 2008 is we went down steeply, and then we came up real fast. You know, so we were very fortunate in that regard. You know, we have to be ready for a market that declines and ends up being more U-shaped as opposed to V-shaped. We're in a more prolonged period of time. We're more concerned not about a 2008, but about a 2000, 2001, 2002, where the market continues to go down over a 3-year time period, as opposed down sharply and up sharply in the space of 18 months. That everyone we think can survive and work their way through. So again, when we build these defensive playbooks, these crisis playbooks, we're looking back to the popping of the tech bubble, less so the sharp decline and big spike back up that we saw in 08 and 09. So we in fact look at 14 different beta factors for every hedge fund manager that we bring into our portfolio. Now, that doesn't mean we've captured every beta factor out there, but we think we captured most of it. And what we're looking for are those hedge fund managers that really do have very low exposure to broad market indices, whether it's a cap-weighted index, a duration index, a credit index, a crowded trade index, et cetera. And so we're trying to get as much of that out of our hedge fund portfolio and just focus on a differentiated return stream. One of the things that people tend to forget about hedge funds and active management is that it does produce alpha. Alpha, by definition, is not beta. It does diversify your portfolio. And so one of the things we have done is we've looked back over the last 30 plus years. And when you go back through the last 30 plus years, the down markets of 2008, 2009, the popping of the tech bubble, the recession of the early 90s, et cetera, active management outperformed in every one of those years. And so active management does add some buffering to your portfolio. So we still believe in active management, although we use passive as well in our portfolios. But we're trying to, again, be as smart as we can about what is the beta and what's our exposure to that beta if the market takes a dive, what are our pools of liquidity, what's our game plan if we have one of those huge speed bumps, and what other differentiated sources of returns can we bring into the portfolio.
Just quickly, Deborah, Itay, anyone you want to add anything to that? I think it's a good broad question. If you're worried about some kind of this coming to an end, at least for a while, as things often do, what's a defensive piece of wisdom or advice?
Go ahead, Itay.
I mean, one obvious thing, obviously, is to short the assets that you think are particularly overpriced, which, you know, before 2008, for example, was real estate. I think one thing that would be difficult these days is that many things are overpriced at the same way, so that strategy is more difficult to find, I would say. I share the view about active management sort of being counter-cyclical. I think empirical evidence has shown that, and indeed this is something that one could do.
Okay. Another question? Okay, right there.
We're seeing with Saudi Arabia and China doing a deal where the oil will be priced in yuan as opposed to the dollar, which has been the case for so long, and Russia also trying to do that, the same thing, and have Russian gas and oil be priced in their currency, and what all that means for the dollar, and if there's not a long-term trend here underway that will affect the dollar negatively. And do you view that, do you guys view that or have an opinion on that? And how do you factor the dollar into your investment outlook and your particular investments?
I guess.
I don't have any thoughts.
Okay.
So I'll give you a couple topical thoughts off the top of my head. Back to our President Trump, one of the things everyone expected was we're going to have a really strong dollar. Of course, it's weakened over the last year. So if you were betting on that at the beginning of the year, you lost out. So be careful on currency bets. We do not take currency bets at the Commonfund. So to the extent we invest overseas, we try and hedge out that currency risk. We view it as an uncompensated risk. Currency is just a numeraire commodity to which you denominate everything else. Back to oil being priced in a different currency, it is fascinating where you trade oil around the world, whether you're trading it in London or here in the US, it's priced in dollars. So to the extent you'd have the most heavily traded commodity in the world priced in an alternative currency, possibly you could see it having some weakness attributed to the dollar as a result of that. But again, that's more a geopolitical issue and one beyond my skill or expertise. It's a fascinating thought, though.
Itay, final thought on that?
I mean, I do think there is a trend in which the U.S. is losing, the U.S. dollar is losing its dominance. It's no longer the reserve currency by default, I think. I think there are now competitors on it, and certainly this will affect the strength of the dollar. So I think this is just one piece of evidence. But in general, I do think that, if you think about the whole geopolitical issues, I think certainly that the U.S. might not be the default reserve currency going forward, yes.
All right. Well, I think we're supposed to wrap it up now. So I'd like to thank Mark Anson, Deborah Fine, Itay Goldstein. Fascinating conversation. And thank you very much. And again, thank you. Wonderful audience.